Hello and a very warm welcome to this webinar, Navigating Europe's Stormy CRE loan and CMBS markets from a credit and regulatory perspective, brought to you by Scope Ratings. My name is Keith Mullin and it's my pleasure to be your moderator for today. Now, commercial real estate has, of course, been front of mind this year for a whole host of reasons, not many of them positive. The objective of today's session is to highlight some of the key factors around this asset class and offer some guidance around how to navigate the pitfalls. To do that, I'm delighted to have on the call today Florent Albert, Head of CRE and CMBS Ratings at Scope, and our special guest, Peter Cosmetatos, Chief Executive of CREFC Europe, the trade association for the commercial real estate finance industry. Now, in a moment, Florent and Peter will take you through a presentation that will cover a lot of ground. And Florent, as part of that, will also outline the benefits of Scope's new scorecard, a credit assessment tool tailored to CRE loans and CMBS. After the presentation, we'll be happy to take your questions. So please do type these into the platform as we go along. So that's it from me. Florent, Peter, it's great to see you. Florent, I believe you're going to kick us off. Let me hand over to you.
Hi, everyone. Thank you, Keith. So I imagine you can all see my screen. Peter and I are going to present the state of the CRE loan market through the lens of the CMBS public data and performance. And then we will move to a more regulatory angle where Peter will talk about the bank and debt fund regulation, while I will cover the Solvency II and the insurance and the challenges for the insurance companies. We will also discuss about the scorecard that indeed Scope has released recently to address some of these challenges. But before starting, I would like to apologize on behalf of Aviva UK that was supposed to join us to cover the insurance side, and I will cover in the absence. So let's move directly to the first slide. So here it's about presenting really this new paradigm in which we are at the moment, where after 10 years of compression of the yields across all the asset classes, we have seen since H1 22 and these yields bottoming up by roughly 20-25% in average. In the meantime, the cost or the borrowing cost here expressed in terms of corporate borrowing cost in Germany has increased significantly by here more than 300%. As a consequence of this, the leverage return is for the first time since the GFC in negative territory. So all the markets in real estate are therefore impacted by this. No one is immune. But what we want to discuss today is that the impact is not the same everywhere across all the property types, but also across and within each of the property type. So moving to the next slides, here we are presenting on the high level this kind of performance dispersion that we see across fixed income. So on the top right hand, you have this rating drift that is the Scope rating actions in terms of upgrade and downgrade through the fixed income since 2019. So since the Q1 22, we have a negative rating drift that even became into negative territory in Q4 22. Real assets and especially real estate are among the contributors to this negative rating drift. Now, while it's still early stage to draw conclusions, there are some trends that are emerging. One of them is the term defaults piling up in some niche or some pocket of the markets, including construction, where the delays post-COVID and the cost post-COVID of construction, combined with reset growth to develop value, have led to many projects being defaulting, and ultimately lenders looking at what are the options in terms of restructuring of the financing, but also about how to what to do with these partially completed assets. We also see the refinancing concerns growing through different pockets of the markets. One is across the Nordics and Germany for two distinct reasons. On the Nordics market is mostly about the short-term floating rate mortgages, while in Germany, following 2 or 3 decades or 2 decades of safe haven sentiment, financing that are above average level in terms of LTV. We also see some of the loans that have been underwritten at the peak of the market, so at the end of 21 or 21, early 22, to be under stress because the value of the assets have been severely impacted, and therefore many of these loans are now in cash trap or even in financial hard covenant default. We also see that some sectors are impacted, and the office sector is one of them. We are going to discuss about this later on. That leads to distinct workout strategy from services and from special services. We see some that are, especially in the CMBS market, taking an approach of pretend and extend type of approach, where the loans are extended without any counterparties from the borrowers, and with the lenders accepting these new terms because they don't want to enforce these assets and feel that they won't do a better job than the borrowers on these assets. We also see some other services and banks taking a more hard view and pushing borrowers to rediscuss some of the terms, pushing them to do equity injection, to rediscuss the pricing of these loans. And therefore, all of this is an ongoing development, and that we are only going to have a clear view within the next likely 12 to 18 months at least. Now, moving to...
Florent, can I just jump in, actually?
Sure.
Just to say, I think that picture of performance dispersion that you describe makes a lot of sense. If I pan out a little bit and look at the CRE debt market more generally, so not just the securitized stuff, but everything that's sitting on bank balance sheets and elsewhere, and particularly speaking from a UK market perspective, I think because we don't have those characteristics that you described for the Nordics, where you've got quite direct and immediate exposure to rising interest rates, we really do have a market that is being affected in different ways and at different speeds. There are various cyclical factors and structural factors that are affecting different assets, different loans, depending on when they were originated. Exactly the kind of, the kind of concern areas that you've identified in those Roman numeral bullet points. But what we don't have is what we saw in the GFC, which was the whole market falling, 40% in a year and a half or whatever it was. Or the same situation, actually, even that we saw during the pandemic, when whole sectors of the economy moved quite significantly over a very short period. I think here it's a much more nuanced picture, and I think it really is going to be different assets performing in different ways depending on when they were leveraged, how they were leveraged, what the interest rate hedging position is, and the changing views that people in the market are taking about structural factors like the value of office buildings, which I think is very much still up for grabs. I know you're going to get onto that in a minute. The decarbonisation picture and what is sustainable, and other structural and cyclical factors in the market.
Oh, absolutely. So let's move to the next slide, which is about the performance in terms of rating, to illustrate on the CMBS market this ongoing deterioration, but also this dislocation or dispersion in terms of quality. So on the bottom right side here, you have an extract of our scope rating CMBS tracker, which is a tool that we developed internally and that is available for the ones interested. And here it presents through all the transactions since 2017. So all the transactions that have been issued since 2018, actually, the rating migration in terms of average notch change across the capital stack. And that's around 40, 50 CMBS and 80, 90 loans. So we see that the retail sector has been severely impacted. Some of these CMBSs that are famous, like the Elizabeth one in the shopping center in the UK, have seen almost 8 notch down across the entire capital stack. Some others, the Trafford Center also in the UK is a known one. But we have others in Italy, like Pietranera, etc. What is also interesting is that we see in the office sector the cracks with some of these CMBSs that are under pressure. Some of them are actually refinancing in 2024. That's the case of Viridis office in the UK, but it's also the case of Salus, for example. And we have others like Atom, which is one in Germany. Now, the rest is quite, I would say, not surprising. Industrial is a bit up, residential stable, and mixed use or other is a mixed bag with diverse performance. Now, when we look at the left-hand side, here we have by the notch, the category of ratings, how the ratings have moved, and here by class of note. So obviously, some of these transactions that we discussed, like Deco Vivaldi, but here Elizabeth, across the capital stack, have seen significant change. But what is interesting is if we were to look only at the rating movements in 2023, for example, we see here that there are some upgrades related mostly to transactions that have deleveraged, i.e. assets that have been sold, and equity injection, but also significant downgrades across the capital stack. While one could have imagined that the AA and AAA tranches are more stable, that's not really the case given the questions arising about the ultimate value of some of these assets. And therefore, you see some transactions that are impacted across the entire cap stack. Now, the reason of that are various. One is, one offset of it is we see income growing through all the deals and generally equaling or beating inflation. But at the same time, the cost side that often over the last years has been disregarded or underestimated is also growing. And that's something we are going to look on the next slide. So moving to the next slide, here, what do we see? You have this chart that represents the change in loan to value and change in debt yield in percentage points of the loans that have been securitized since 2017 in the European CMBS market. The key points that I would like here to highlight is about the change from 2022 onwards, which for us represent the inflection of the market. So here in the chart, what you see is the performance in debt yield change and LTV change for all the loans that have not been repaid to date. What do you see? We see that we have generally, excluding the green ones, which are the retail loans, more like a compression in terms of loan to value that are coming from the assets being revalued up, but due to yield compression. In the meantime, the change in debt yield is not significant, i.e. income has been generally stable in terms of NOI. And we see some of these office that have been revalued up. Now, when we move to post 2022 to 2020 to the latest levels, we see slightly different picture. We see some of the income going up, especially for the operating assets like hospitality, where until now, until 2022, and due to COVID, they had underperformance, but the fundamentals are strong, and therefore the income goes up. In the meantime, interestingly, we see some of these offices starting to be revalued with 10 to 15% loan to value increase. We see a dispersion in terms of logistics, where some of these UK logistics that have been repriced significantly have seen their LTV growing, while others, due to strong fundamentals or to income growing, have seen their LTV and AP going up. Sorry, LTV going down and AP going up. Now, we expect this dispersion to continue with the office sector, especially for single assets and secondary location assets, to be under pressure because of higher vacancy, and we are going to see that later, as well as ERVs that are reset. Retail may continue to suffer, but we believe part of the retail is bottoming up, and we see some of these valuation here that are increasing again. And finally, industrial and residential, especially in continental Europe, will be suffering more than in the UK, where the revaluation have already been quite aggressive. But just to make a comparison between the CRE loan market and the CMBS, and the corporate market, at the moment, European real estate corporates are trading around 30% below NAV value, while this repricing has not really and have been done in the CRE loan market, where we have seen 10, 15, 20%, but not to a 30% extent. So, yeah, Peter.
Yeah, just to comment on the office market. So I think certainly in the UK, there's been a quite substantial repricing downwards, although by all accounts, there continues to be quite a sort of disagreement between buyers and sellers about what offices are worth. I think my main thought is that even though the combination of post-pandemic technology, society-related changes in how we use office and where value really resides, I think that is significant. And I also think the other thing that's significant is the decarbonisation and sort of sustainability, ESG type challenge for offices. I think both those two things are really significant. But I also think the market so far is reacting to both of them in quite simplistic and kind of binary ways. You know, there's the best and the rest. And I think the picture is going to be much more nuanced. I think we're going to find that there are a lot more decent office buildings that at the moment are being kind of marked down when people begin to realise that there is demand for them and that the cost of improving them maybe isn't completely overwhelming. In much the same way as, but hopefully on a more accelerated basis than happened with retail, which for a very long time was deeply unloved. And finally, you know, in more recent times has begun to recover, as we've all realised that we do still want retail. You know, we had too much, but and maybe it wasn't priced quite right. But there's certainly a place for it in the future in our towns and cities, and therefore in investment portfolios and lending portfolios. So I think the main question for me is how we use offices. I think it'll be years before that really becomes clear. So I think we'll do well to remember that the picture is probably more nuanced than the market is currently seeing it.
Yeah, I absolutely agree with this. And when we think about the parallel with retail started to be under pressure in 2013-14, and it took almost 10 years to go through the cycle and to really see to bottom up and to also see which assets are performing and the ones that are not performing. And actually here now, when you look at the performance of all these loans since, again, 2018 to now, you see also dispersion, with some of the retail here having a significant increase in loan to value, but others that have seen a good performance and some that have seen the value going up. And we see the same with the office ones, with some that are already quite I would say I've seen a good performance, and others that in terms of value that is not up. But again here, and that will lead to the next point, is we have quite a lot of dispersion on the horizontal axis, i.e. about LTV. We don't have too much in terms of debt yield. And that will lead to the next question, which is about refinancing. So moving to the next slide about refinancing. Again, given we are taking the view from the CMBS to illustrate some of the challenges that the CRE loan market, which is much bigger in Europe, is facing, I think a slide like this is quite self-explanatory. You have here across all the CMBSs that have been priced since 2018 by tranche, i.e. by rated tranche, the pricing of these tranches. So if I take the point at the moment of the Ukrainian crisis, we were having AAA at 1.1 on a 12 months trailing basis on average for the margin, and the BBB at 2.7. Let's disregard the B. Now, with this 1.1 and this 2.73, where are we now with the last 3 deals? We have actually double. So today, a AAA tranche, a AAA tranche is costing of AAA tranche of 2022 is costing now the a BBB tranche. When we look here, the BBB tranche was at 2.7 and the AAA at 1.1. Now when compare here, it's basically the AAA is at the cost of the BBB a year and a half ago. To this, we need to add the base rate that went significantly up and the hedging cost. So all of this together means that for borrowers, they are facing an extremely significant, challenging environment where they will need either to deleverage, either to increase significantly the income part, or find innovative solution with their lenders to be able to refinance some of these transactions. So moving to the next slide, here we want to discuss a bit more in details the refinancing risk. So in January 2023, we issue a note where we're estimating that a third of CRE loan in the CMBS market were facing refinancing risk. It was perceived at that time to be extremely high number. The reality is that we were short. This year, 40% of the CRE loans didn't refinance. It's 8 out of 20 that either were forced to be extended beyond their full legal maturity or to default. So if we look at these loans only, what do we see? And we take the extended and defaulted for 2023. Their debt yield were generally strong. We are speaking about loans with debt yield above 10%. But the loan to value following the revaluation of their assets are extremely high and don't find lenders keen to refinance these assets. It's especially the case for some of these assets that are exposed to the Italian market. But it's also the case for some of the office, with Frozen being the most known one, which is the Blackstone portfolio that defaulted in the Nordics. Now, if we just look at the ones that are performing or reperforming today and that at some point will have to refinance, and looking at these two lines, i.e. the lines at 55% LTV, which is where generally in the today's market condition, senior lenders are keen to refinance, and the debt yield at 9%. What do we see? Is that the 9% debt yield mark is not putting too much of the loans, half of the loans probably under pressure, but there is still ways to go away with this for borrowers, with lenders, if there are reserves, etc. Now, we still see that a lot of these residential loans are under pressure from a debt yield perspective. Now, The key factor is the loan to value, where we have many loans here, like maybe 2/3 of these loans that have loan to values on the 60-70% mark. And these loans will struggle to refinance under the current environment if both borrowers and lenders are not working together in advance of the refinancing date to find a solution, either by having asset deleveraging, equity injection, different type of source of financing. We will talk about this, and Peter will mention that about non-bank and bank funding. But all of this will have to be thought through carefully for not having a wave of loan defaulting. So moving to the next slide, here it's the loans that are refinancing in 2024 that have no extension options on the table on the left-hand side. On the right-hand side is the refinancing wall. What do we see? Is 2024 has more than 5.56 billion of euro equivalent debt that will have to refinance in the CMBS market. That's significant for a market that has 16 billion in total. But if we are looking not on the scheduled maturity date, but only the extended, i.e. the full extended maturity date, so no extension options, the picture is different. Because here we have only 3 billion roughly, and most of these loans have extension options to 2025 and 26, which makes sense because the peak of the market being 2020 and 2021, loans having generally a 5-year maturity, the peak or the refinancing date of these loans will be 25, 26. Now, we have here given a view on the refinancing risk of these loans. We are actually going to issue a research to explain our views and what we believe is the case. But in a nutshell, we see lack of liquidity in the Italian market, with many of these Italian loans that have stabilized portfolios to struggle to refinance, and actually they have been forced to extend already by 1 year. We see some pocket of stress in the single asset office market. Please note here the levels of vacancy across these office assets. We are speaking about 10, 15, 20%. Again, it's not a conclusion to be drawn for the entire market, but there are assets that are already suffering from the remote work and structural vacancies to this market. Peter, would you like to add something on this?
Yeah, so we're about to go into the regulatory view on banks, and I think I'd start with I mean, clearly the picture you've described is interesting and important. It's refinancing that is the main obvious challenge in the context of rising interest rates, is the main thing that has been driving the repricing of real estate over the last year or two. And obviously that places pressure. I mean, you've talked a bit about debt yield, which is used a lot in this market, but also on interest cover and LTV being the two main traditional measures in the market. The other factor that has been driving some of the stress and some of the kind of resolution challenges in the market is simply what's happening to RWAs, the risk-weighted assets on bank balance sheets. Because in many cases, when banks are having to reassess how strong particular exposures that they have look, and they're having to regrade them either using their internal models or using the standardized approach if they're revising that already, or using whatever it might be, slotting, notably in the UK market, they're finding that the regulatory capital cost of those assets is increasing substantially, and they are intervening quickly. I mean, the most important thing to notice about this slide for me is that total number of outstanding Euro CMBS, which is 17 billion, which is trivial in the scheme of things. I mean, it's interesting to all of us who are interested in this market and to investors and issuers and everyone else, but it's a tiny part of real estate financing. If we, I'll just use that as a jumping off point to talk about Basel III finalisation. If we can go to the next slide. So there's been one really interesting and important backdrop driver in regulatory terms that has shaped a big difference between the UK real estate financing market and most of the Eurozone financing market. And that is the imposition of slotting as a capital framework for real estate lending by the big UK banks. So whereas the big European banks, Eurozone banks, are generally using internal models, the big UK banks have been using slotting. The effect of the introduction of slotting, and I've got a lot of problems with slotting. I don't love it. I don't think it's a brilliant system, but it's had a fantastic, two big fantastic effects, one of which was to constrain leverage by banks. So it has kept the level of risk in the UK banking system at modest levels. That is not what we've seen in certain other major European markets, most very notably Germany. And secondly, by constraining the appetite of the UK banks for real estate exposure, the introduction of slotting for them created space for other entrants to come into the market. So the UK has a much more diversified landscape. What I'm going to talk about just for the next few minutes, and I'll try and make this as brief as I can, it gets quite technical quite quickly. I'm going to assume a certain level of knowledge and just give the headlines. Basel III finalisation, which was agreed by the BCBS, the Basel Committee, in late, I think it was around this time of the year in 2017, so 6 years ago now. Most of it hasn't come into force yet, the finalisation. One element that's important that we'll talk about is coming into effect by stages, and that's minimum output floors, which is very important for the IRB, the internal rating-based banks. Basel III finalisation is going to have a significant continuing impact on how banks are exposed to real estate and what kind of position they want to have in that market and how they decide to gain their real estate exposure. So Basel III finalisation's got different names in different jurisdictions. The UK calls it Basel 3.1. The Americans call it the Basel III Endgame. It's broadly, I would say, unhelpful for real estate. So for the biggest factor for the European banks, the big internationally active ones, is minimum output floors. What that requires them to do is to calculate their risk-weighted assets using their internal model at a firm-wide level, and then to recalculate them using the revised standardized approach. The revised standardized approach routinely gives higher capital charges, right? Higher risk weightings to things, to most of what banks do. And what minimum output floor says, unless your IRB calculated RWAs are at least a certain proportion of what they would be under the standardized approach, you have to top up your RWAs and set your equity tier 1 capital by reference to that topped up number. So the effect of that has already been felt in European markets and is being felt more with each passing year as banks find it more expensive to make real estate lending cost effective for them in regulatory capital terms. So what that means is not only are base rates going up, not only do we have interest rate changes driving up the cost of capital, we also have banks' own cost of funds in regulatory capital terms. I'm not talking about commercial, but regulatory capital going up, and that is adding to that pressure. Across both the UK and EU markets, we've got something called that the Europeans are calling property value, and that in the Basel framework and in the UK is called prudently conservative valuation criteria, or prudent value. This is a new, untested, not very clearly described or defined approach to valuing the real estate collateral underpinning real estate loans. And it is something that will apply from 2025, when these new rules come into place, in order to calculate risk weights by reference to LTV buckets under the standardized approach. So in a way, that only affects standardized approach banks directly, but actually because of minimum output floors, it affects everyone, because all the banks have to calculate their standardized approach RWAs and compare their IRB derived RWAs to that and make any necessary adjustments. We have been part of numerous lobbying attempts and information sharing attempts with policymakers, both in the UK and at EU level, to try and help people understand that neither the data nor the skills in the valuation industry really exist that would allow this new concept of property value to be implemented at the asset level. And we've been arguing that it ought to be implemented using macro models at the market level to try and understand cycle risk. What the concept is trying to do is it's trying to take the froth off the market, off the valuation, essentially. It's just trying to make sure that if markets are toppy, the value by reference to which you're calculating your LTV for regulatory capital purposes is not a frothy value, that you kind of bring that down a little bit. So it's a little bit like, but a much more simple and different version, but it's a bit like mortgage lending value, Belangswert, under the Van Brief system. But as I say, Belangswert has very clear rules. Property value or prudent value doesn't. So there's the potential for chaos there, even though the idea behind the idea is a good one. And then in the UK, we've also got a problem in that the PRA has proposed two different significant things. One is to apply less risk sensitivity under the revised standardized approach than the Basel Committee recommended and than the EU is implementing. And that's a bad thing. Essentially, the UK doesn't want to allow a lower risk weight bucket, a lower risk weighting for low LTV loans, which is just bonkers. They ought to allow that, but they don't want to. And that gives them less flexibility for encouraging standardized banks to do more lower leverage lending. So that's unfortunate. And the other thing they're doing is they're introducing this additional slotting framework for what they call high volatility CRE, which essentially means construction finance, development finance. And again, that's likely, in very simple terms, that's likely to make the big banks that use slotting want to do less construction finance, less development finance. Just one final point really from that. One of the ways in which I think the economy is likely to need quite significant amounts of development finance and construction finance is in the context of repurposing buildings, improving buildings, and in particular doing deep retrofit and renovations. In many cases, that's going to be a really important way of reducing credit risk and improving the operational potential and future-proofing existing buildings. Banks are being told, don't do that stuff by this new framework proposed in the UK. And I think that's really unfortunate because if banks aren't doing it, I'm not sure who will. And it'll generally be more expensive and more challenging, and the taxpayer is likely to have to pick up the bill at the end. So all of these rules, we still don't even know exactly how they're going to play out. They don't come into force until 2025, but 2025 isn't that far away. Pass back to you, Florent.
Thank you, Peter. So moving to the next slide, where I'm trying on behalf of our friends of Aviva to cover the Solvency II aspects for insurance companies. So on that front, the regulation is governed by the PRA, and for these illiquid and rated assets, it's under the supervisory statement 317, where basically, as part of the guidance, the PRA requests the life insurers to follow and to track and to monitor a couple of risks as part of their internal assessments and as part of their internal models. They also require a broad consistency with CQS, which is this rating band, and with ICAI, so the rating agencies. Now, the PRA has issued a paper in September, this consultation paper 1923, about the reform of the matching adjustment and therefore the application of the regulation for liquid and rated assets. On one point that is well received by the life insurers is that the PRA opens the door to have a wider universe of investment to cover mezzanine financing, non-investment grade investment, construction financing, but at a kind of a cost. One of the costs is increasing granularity assessment, where the insurers will not only have to monitor the risk of their exposures on a broad category base, i.e. on a rating band, but on a notch specific level. There's also a requirement or guidance to have further alignment with rating agencies based on assessment and comparability. Having independent risk assessor within the firm to manage any conflict of interest. And then there are these concepts of appropriate validation, external assurance, and ongoing appropriateness. So what does this mean? And what are the impacts for insurers? The first impact, I would say that's what I mentioned in terms of risk that to be covered. That includes market risk, cash flow risk, refinancing risk, etc. But also having to monitor in a closer way this risk and the credit risk change associated with them. Now, when it comes to the alignment with rating agencies or further alignment or further consistency with rating agencies, the appropriate validation and external assurance is by having external backtesting in a way of the results of their internal model by rating agencies. So on a sample of loans, of assessment of their pool or the book, and aligning further methodologies with the ones from the rating agencies and the tools that they are using. So with this in mind, Scope has developed Scope CRE loan and CMBS scorecard. This tool has been developed by the rating agency, so the regulated entity of the Scope group, for the insurance companies and banks, and actually on request of some UK insurers especially. This tool is used by the analyst in Scope ratings, and the tool is also used and maintained by the same analyst, with the idea to have a further transparency about how we look at real estate, but also having further alignment, i.e. providing access to our tool, because if the external users were to use the tool and input the same assumptions and underwrite the loan as we do, they would have the same results as the Scope's outcome. The tool covers the list of risk that the PRA mentioned in this 317 and 1923 papers. So market risk, cash flow risk, liquidity, collateral, etc. It's important to mention that the tool and therefore the approach of our methodology is expected loss based, but we also incorporate probability of default, especially around the term and at refinancing as well. We look at the collateral value based on the discount cash flow approach. We don't take the collateral value as per the valuers. We also look at the risk around counterparty risk, where we have where the tool provides a Monte Carlo simulation around the probability of default of the underlying tenants. Climate risk are also incorporated through capex assumptions, etc. So I will now present in 2 or 3 minutes the key elements of this scorecard. And if anyone is interested, feel free to contact me afterwards for demo or further information. Now, looking at my slide here, or my presentation here, the tool is available through Scope 1, which is the Scope online-based solution. And the template, the input template, is an Excel base that you upload to Scope 1. There is a validation layer, and then the tool will calculate the results and provide these results in form of an insightful dashboard that is downloadable and dynamic. So this dashboard will look like this, where you will have a first page with the score output and with the equivalent PD and EAL for each loan, if you have a CMBS, or just a loan if you have a CRE loan. And then you have a couple of tables or tabs that look at the collateral, then the tenancy, and the loan level. I'm not going to go through all of them. I will just present you some of them. So you will have an overview of the CMBS, the structure. You will have information around the loan and a loan by loan basis. So here is a CMBS we issue a rating report at the beginning of the year, but you will have the assumptions and the details of these loans presented in a standardized way. You will also have information around the top collateral performance, the vintage in terms of when the assets were built, the distribution in terms of collateral type. You will have information around how the cash flow have been underwritten and what are the results of the model, i.e. per property over time, how the cash flow have evolved. You can select property by property to see how the cash flows have been modeled. So here you have probably a tenant that vacated or defaulted on its lease, and then a relating. You will have information about how the collateral value evolved through time, again on a portfolio basis or on a property by property level. And you have then on the loan level information about the key ratios and how they have evolved over time. So our approach and the scorecard is a Monte Carlo simulation. So here it's present only one iteration out of the 1,000 of iteration you may run, but it will give you a good indication of how the transaction performance has evolved as per our projection, as well as at refinancing, what is the estimated refinancing rate versus the actual one, and then the cash trap associated to that, and whether or not then the cash trap will lead to a cash sweep. So this is really about the scorecard. Now, again, if you have any interest in the scorecard or on the Scope CMBS tracker, feel free to reach out to me after this presentation. So going back to our slides, I think it's time for a conclusion. So here we have written down with Peter a couple of conclusion and open points for also opening the discussion and for any questions you may have. First of all, as mentioned, the risk around default at refinancing and enforced maturity extensions remain elevated in 2024 and likely early 25. For the reasons we explained, for also the funding gap that is increasing, i.e. debt being more expensive and regulate or bank lending reducing. The assets valuation that will continue to be challenged. So far, we have seen valuers adjusting, especially in the UK, significantly their yields. We start seeing capital and operational expenditures and estimated rental value assumptions to be revisited, but it's rather slow, and we expect further changes on that front. And then we also see some, obviously, movements from the regulators, especially on the bank and the life insurers, that create some opportunities for alternative lenders. Peter, I'll let you on the third.
Yeah, I'll take the next few. So that regulatory pressure on banks, which is undoubtedly pushing them towards less and more expensive direct commercial property lending, is actually indirectly likely to help them want to continue and increase their funding of non-bank lenders. So we've seen a lot of loan-on-loan, repo finance, generally termed back leverage, of banks and other funders providing loans to debt funds and alternative lenders that they deploy alongside the capital they raise, the equity capital they raise from their limited partners in their real estate lending. So even in a country like the UK, where you've got a really large slug of non-bank capital coming into the credit market, real estate credit market, actually no one knows how much of that non-bank capital is coming from banks, but a fair chunk of it is. And one of the main reasons why, there are good commercial reasons as well, but one of the main reasons why is because there's allegedly a large regulatory arbitrage from that. The regulatory capital cost, the scrutiny, the reporting, everything is much, much lower for lending to debt funds that are lending to the market than for lending directly against commercial real estate. I don't think that's something that policymakers necessarily understand or intend. I don't think it's necessarily a bad thing, actually. But it's certainly something that I think is going on out there. So that adds to this notion that actually there's a real role potentially for alternative lenders to play, and a role for banks to fund them rather than lending directly as much as they used to. I think that also links to the penultimate point here about decarbonisation of commercial real estate. It seems to me that the CRE CLO market would be an ideal place for refinancing shorter term value add transitional funding to real estate. And I can imagine a really good model where you've got non-bank lenders providing a lot of those facilities to the market, with banks providing back leverage to those non-bank lenders, and then those arrangements being refinanced through a CRE CLO market. That could feel like a really good way of driving a lot of the decarbonisation of the built environment that we need to see over the next 10 or 20 years. There are real barriers for making that happen. One barrier is actually the main factor is going to be how regulators want to approach this. They've generally been very unhelpful for securitization of commercial real estate debt in the European markets since 2013, and that might need to change. And I also worry that regulators might suddenly decide that they don't like back leverage, which would be a bad mistake, I think. And it's possible that you get regulatory interventions that further distort how capital comes into the market. But I think that decarbonisation challenge is a huge opportunity, potentially, but we'll have to see whether we manage to capture it.
I think we arrive at the end of this webinar. I don't know, Keith, if you have received any questions you would like to address to Peter and I.
Yeah, yes. Well, first of all, thank you very much to you both for a very detailed and very insightful presentation. And thanks to everyone for staying online and watching. So I think we should potentially close in pretty short order, but just a couple of quick things, if I may. Florent, could you talk about the issuance outlook for real estate securitization in 2024, based on everything you said?
Yeah, sure, Keith. I think I can cover that, but also hopefully trying to do a bet on the CRE loan market more generally. 2023 has been a really low issuance or low origination year, with origination volume down by 40-50% across some markets. On the CMBS market, we have seen 3 issuances, all of them after the summer, and we expect to see a couple in beginning of 2024, and hopefully the market will restart in a more healthy way in terms of issuances. Now, I think the point from Peter about CRE CLOs is probably what many on the markets hope, because alternative lenders have been expanding significantly, and they have a large loans and balance sheet that they could refinance through the capital market. But it's about who is going to be the first one to issue CRE CLO. So we hope and we expect after this year of price discovery, both on the asset side but also on the financing side, to see more a return to more normal conditions in 2024.
Yeah. Okay, thank you. Peter, one, if I may, we talked a lot about refinancing risk. We also talked about the fact that a lot of commercial real estate is funded by banks directly and indirectly, and by funds. Can you give us just some sort of broad takeaways about the experiences in refinancing where debt funds are involved as the primary motivators versus banks?
Yeah, I mean, that's a really interesting question, because traditionally, and certainly in the days of the GFC, everybody's the kind of received wisdom was that banks were the right people to have as your counterparty if you were a borrower. You know, the bank would be someone you could talk to. They take a long-term view. It was a relationship. Whereas with non-banks, you know, there was this fear of a loan-to-own strategy. They're going to be really aggressive. They're going to want to just kind of cut you loose, take the assets and run. I think what people have been reporting universally, actually, in the UK market, in the Irish market, in pretty much every room that I've heard this discussed, is that it's almost the opposite. The banks are laser focused on identifying and resolving problem loans and deciding. I mean, I'm not saying that they want to, you know, they're being really brutal with everyone. I don't think they are. They're being, but they're selecting which are the assets, the sponsors they want to support, and which are the ones where they want to just move quickly to get them off their books. And the driver for that is RWAs. It's the fact that actually we've got a relatively pro-cyclical capital framework, and the banks are having to re-rate assets when things, you know, get tested for LTVs, get tested for income. Clearly, when things get, you know, when loans get extended and hedging costs shift and everything else, when banks reassess loans and see that their risk ratings go up. If they think they're in the money, or if they think that the position is only going to get worse, they're quite quick to intervene. Whereas debt funds are much more pragmatic, as I understand it. They really don't want to go back to their investors and give them losses. And so it's very important to them to find ways to resolve problem assets in a pragmatic, partnery kind of way with their borrowers. So it's an interesting reversal compared to what I think many of us would have assumed, 10 years ago.
And if I may, Peter, staying with you just very quickly, you talked about decarbonisation. I was wondering, could you just recap whether you think that the decarbonisation of commercial real estate will get financed, given it's a transition play? Does that create problems, or are you comfortable that it will get done eventually?
No, I think decarbonisation will get done because it has to get done. I think in an ideal world, what you would see is what the Dutch banks have done, what ING in particular did in the last 6 or 7 years in their market, where you've got a domestic volume lender with very extensive reach into the SME market of CRE owners, able to bundle together technology that can generate advice and business plan recommendations for retrofit interventions with the financing to help pay for them. Unfortunately, I think the approach that regulators are putting in place, both for risk weightings and for the reporting of financed emissions, will discourage banks from taking that kind of approach in the future. Some might still take it because they'll see themselves as having a broader range of objectives and commercial goals and public goals, reputational objectives. But the financial regulatory incentives being put in place will discourage banks from doing it. And if banks are not doing it, and banks don't want to hold browner assets and don't want to finance improving them, there are going to be real challenges for the market. I think that itself presents a financial stability risk because of the exposure that banks already have, because of the implications for values. If the lowest cost of credit ceases to be available to large parts of the real estate market because assets need to be improved, and the cost of improving it can't come from cheap credit from banks. So I think it'll be more complicated. It might take longer. It might take more public sector support. I don't know, but it's going to happen because it needs to happen. I've just seen that there's also a question, and with apologies for kind of keeping this on, there's a question about back leverage. Yes. And whether investor risk appetites need to change, this being LPs, I guess, if they wanted to be in unlevered debt funds, is it a leap for them to get comfortable with levered funds? I think in many ways, investors have already made that leap and are already comfortable with it, because my understanding is that most debt funds, certainly in the world that I speak to them, are already using leverage, where 7 or 8 years ago, most weren't probably. And I think the important thing to remember is it isn't only risk, it's also return. So the reason many debt fund managers have been able to deliver the returns that their investors want is because they've stuck a bit of leverage into the system as well at the level of the fund. It's a very complicated world. The ways in which the back leverage provider gets comfortable and protects its position vary. So it might involve some kind of recourse, it might involve some kind of fund level guarantees, it might involve cross-collateralization, it might involve the ability to make margin calls. There's a range of different kind of structures and approaches, which I'm only beginning to learn about. But on the whole, I don't think it's a huge challenge for the investors in the funds. I think it is a challenge for borrowers, for many of whom it will be completely invisible and they won't understand what's going on in the background in terms of how decisions are made about their loans. I think it presents a challenge to policymakers because they ought to have more visibility of this market, but I think they've got left behind. They're still focusing on the things that they worried about in the GFC. They haven't really haven't really maintained dialogue with the industry, I have to say, and I don't think they're as aware of what they should be paying attention to as they could be. I think that, and I think there's inherently an issue for the debt fund managers who just have to make sure, as any levered position holder has to be able to do, they have to make sure that they can manage that leverage, because it'll amplify the upside, but it can also amplify the downside if they don't manage it well.
Certainly.
If I may, I think it also, for this asset-backed financing, may also help this debt fund to source better quality assets, because they will have I would say a cheaper source of funding. So ultimately for the investors, they may also in a way be reassured of having the GPs investing in assets that are probably or potentially of above average quality versus what they used to invest in.
Mm-hmm.
Yeah, look, we're just on the hour, so I just wanted to, Florent, I've got one question, which perhaps you can answer in 30 seconds. Would you talk briefly about the CRE CMBS scorecard? Can you just share very quickly any user feedback you've received so far on it?
Yeah, sure. So it's in use by a couple of insurers in the UK and Europe, as well as by banks at the moment testing it. So the feedbacks we receive is that it's a complete tool with insightful and dynamic dashboard that can be used to really understand the credit risk of the loans and how the scorecard works. It's also given it's provided by the rating agency and designed by the rating agency. There is a full alignment with the rating agency that will address, especially in the UK and the solvency, some of the expectation from the PRA, and that this tool being extremely powerful in terms of how flexible it is, it allows to model many type of financing with or without capex facility, with or without stabilized assets, etc. So that's so far the feedback are quite good, and anyone that would be interested in knowing more about it, please reach out to me.
Good. Okay, thank you very much. On that note, let me close the session. So thank you once again to Peter and to Florent for your comments. We covered a lot of ground there. And thank you to our viewer for staying till the bitter end. This session will be available for on replay on YouTube. I think hopefully this afternoon. And as Florent mentioned, please do look out for the research note that he's in the process of preparing, which will be largely, I guess, covering some of the ground today, which you can find on the Scope Ratings website when it's published. And if you have signed up to our structured finance list, you will receive it by email. So that's it from us. I wish you all a very successful rest of the afternoon, and stay tuned for our next session. So it's goodbye from us.
Thank you. Bye-bye.
Thank you. Bye-bye.